Well, I'd say first of all, I feel really, really fortunate to have chosen to work on a startup that I really care about, like just genuinely care about. I think it's like, there's lots of different ways of doing this, and there's probably lots of successful examples that one can point to for, a founder who kind of discovered a problem and decided to go after it because they thought it was a good business idea and built, a multi-billion-dollar business, and everyone was super happy. For me, though, I really have benefited from working on a problem that just like has kept me up at night for so long, that I care about deeply. And, when you have a bad day or a bad week or a bad month or a bad quarter, which inevitably happens in startup life, that you can kind of turn back and say, I really care about this. I really, really care about that. I'm going to keep going. I'm going to keep going. Having the grit and the desire to keep going is I think, critical. And that's been a useful tool for me.
To put it simply, John's background is plain cool. From studying dye-sensitized solar cells at Stanford, to navigating startup operations at StartX, to joining the stellar team over at Spark Capital, to then taking the leap to found Standard Metrics. This episode has it all. There are so many insights here that traversed not only just founding and scaling an exceptional business, but revealing the patterns and principles learnt from the viewpoint of someone who has invested in a range of founders and companies in the past. Whether you're seeking to understand investor psychology or looking to scale your own venture, John's deep expertise and unique vantage point make this episode a masterclass in startup building. Enjoy.
John, welcome to the first podcast.
Welcome. Thanks for having me.
So as an outsider looking in, it feels like you've had a fairly unique career up to the point of founding Standard Metrics. But I guess maybe as a quick primer, do you just want to introduce yourself to the audience, plus give us an update as to what Standard Metrics actually is?
For sure. So my name is John Melas-Kyriazi, founder and CEO of Standard Metrics. My background, as you alluded to before, started out my career as a research scientist, ended up finding my way into the world of venture capital, and now with Standard Metrics, working on building software to help the venture capital and other adjacent industries to make better decisions, better data-driven decisions, and operate more efficiently. So yeah, kind of taking this journey from a researcher to a practitioner of investing to a builder.
Does that say something about you? Is it like I kind of think about myself sometimes in different career paths. Is it something that you just get a bit bored at something, or you want to tackle something else? You want domain expertise?
Yeah, it's a good question. I think for me, I've always been a tinkerer and a builder. Like growing up, my parents probably fondly remember me buying a bunch of sort of like electronics. I was even kind of creating my own printed circuit boards in my basement to make.
What age was this?
This was in high school. So making like guitar pedals and guitar amplifiers. I was really into electric guitar and all of the electronics that went into it. And then when I got to college, I didn't know that I wanted to be an engineer right off the bat, but I ended up pretty quickly getting into engineering. So I've always been someone who really enjoyed building, tinkering, and I think, for me, venture capital was a career path that I really enjoyed. I loved getting to work with entrepreneurs who are building, in many cases, pretty kind of exotic new technologies. And over time, as I invested in more and more companies, I realized more and more that I wanted to be one of them.
Yeah, interesting. What was childhood like for you? What give us the rundown? You grew up in Boston, is that right?
Yeah, I grew up right outside of Boston in a town called Brookline. So it's the same town that Boston College is in.
Yep.
I grew up with my mom, dad, and little brother. Alexander's 2 years younger than me. Played a lot of sports as a kid, and then I had this interesting thing that happened to me. I forget exactly how old I was. It was probably like third, fourth grade, where I had these horrible growing pains, and it was really painful to run for a while. And I ended up going from spending almost all of my time playing and thinking about sports to suddenly getting really into reading and books and academics. And that kind of actually changed my life quite a bit. So, I still played some sports. I played, tennis in high school a little bit, but mostly focused on music and academics. And that's kind of what led me into, etching printed circuit boards in my basement and making guitar pedals and guitar amplifiers, and then ultimately, studying engineering in college.
And so you went to Stanford for undergrad and masters, is that right? And then you were going down the academia path at Stanford.
That's right.
Like PhD.
Yeah, I kind of actually started out on a PhD track,
Yeah.
straight out of undergrad, and then ended up leaving with a master's, afterward, but assumed I was going to go down an academic track. For a variety of reasons. I think for me, as an undergrad, I pretty quickly fell into a research lab that I absolutely loved at Stanford, and had the really good fortune of having an awesome mentor who was a PhD student who I really admired. And the first project that I worked on with him ended up yielding some kind of scientifically interesting results. So we ended up publishing a paper that I wasn't the lead author on, but I was, like the second author, if you will. And that was such a cool experience. And then the following summer, I got a chance to go and spearhead my own project, which then ended up turning into another paper that I was the lead author on. So I immediately thought, okay, great. I guess I'm going to become an academic. And then I, the next summer, before starting my PhD, I ended up going to work at a startup. It was my first time working at a startup, and it was so fun. It was so exciting. And when I got back to school, I realized I kind of want to go do that. So I sort of ended up veering off that track. But I have a lot of friends who ended up kind of going through with their PhDs, and some stayed in academia, and some left to go to industry.
It's interesting. We've spoken to a number of founders that have gone down the academia path. Some went all the way through and did their PhD and postdoc. Others made the decision to kind of exit partway through. Obviously working for a startup, getting that experience, interesting. Not everyone that's in academia would then decide to just go, I need to go and do that. What was it about that experience that said to you, that's the path I should be on? Yeah,
I really liked the pace. The pace was so fun. It was every day was extraordinarily energetic, a little bit chaotic. Things were always coming out of left field, good things, bad things. It was this kind of intoxicating experience.
Kind of the inverse of academia.
Yeah, and it's not that I enjoyed my work as a researcher quite a bit. It felt like it was a lot easier to chart deeper and deeper into the future. You kind of could see where things were going.
Yeah.
And I think I enjoyed the slightly chaotic aspect of the startup. And also the people that were attracted to the startup similarly had this, optimistic, positive, creative mindset that I really enjoyed. So it was fun working there.
So we're referring to StartX here?
No, so this is actually a different startup. I just interned there over the summer. StartX, I ended up finding my way into, fast forward a few months into my PhD, I was thinking at the time, okay, well, this might not be exactly what I want to do right now, but I'm going to finish this PhD. It's only 5 or 6 years, right? It's no problem. So I started looking for things to work on the side while I was doing that. And it was kind of a random occurrence, but I ended up bumping into somebody who I'd known a little bit in college, and he had started this program called StartX that was originally part of Stanford Student Enterprises, which is sort of like effectively like part of the student government at Stanford, and then had spun it out into its own separate nonprofit organization. And I told him a little bit about what I was interested in. He said, hey, you should come and hang out and, see if there's ways you can help out with the organization. So I ended up volunteering there part-time. And then after I left my PhD, working there full-time while I finished up my master's also on the side. And I stayed at StartX full-time for approximately 2 years. So that was kind of how I eased out of my academic route and got closer to the startup world.
Yeah, right. And with StartX, was that sort of the aha moment for wanting to move into venture capital?
I think so, yeah. While I was there, I didn't really know a lot about venture capital previously. I'd been exposed a little bit through some classes and stuff like that. But while I was there, I had the chance to get to know a bunch of VCs, on a personal level, people who were involved with the program, sponsoring the program, coming by and investing in companies that we were supporting at StartX and talking about what they did. And it seemed really interesting. I didn't know that I wanted to devote potentially the rest of my career to, servicing that industry and building software and thinking about it, but it fascinated me. It was intriguing. So I ended up, learning a bunch, meeting a bunch of folks. And then at the time, beginning of 2014 rolled around, I had started dating Christina, who's now my wife. And she at the time was getting ready to go to business school in Boston. And, I knew that she was the one. So I said, okay, I'm going to move to Boston too. What should I do in Boston? I had grown up there, but, I hadn't lived there since I was, 18, and ended up interviewing with a bunch of companies and startups and firms, and ended up meeting the folks at Spark, which is kind of how I ended up getting into venture. And then I had also helped at StartX to get this fund off the ground that we had raised from Stanford and Stanford Hospital, called the Stanford StartX Fund.
Yeah.
So that was a little flavor, less of a traditional VC, more of a fund that was kind of co-investing with more traditional VCs, but still definitely a fund in and of itself. So I had a little bit of experience on the, how does a round come together and what do the dynamics look like. And so it was new territory for me, but somewhat familiar territory at the same time.
Spark's, one of the more preeminent firms in the venture space. It's a fantastic place to start your career in venture, I assume, and hone your craft. But for those that may not be as familiar with Spark or what the firm size, shape, thesis was at the time when you joined, can you give us a little primer on what Spark, as a firm stood for and what size and scale they were when you joined?
Definitely, yeah. So when I joined the team in 2014, the firm had a couple $1 billion in assets under management. I don't recall the exact figure. Yep. I think probably between $2 and $3 billion. The firm had just raised their first growth fund. So it was traditionally kind of an early stage fund. And then they had raised a first growth fund prior to me joining. And had also had this just unbelievable wave of successful investments, many of which were in consumer technology. So, the firm was a very, very early, seed investor in Tumblr, was a very early investor in Twitter, which, was on the board of Twitter for many years, was the first institutional investor in Wayfair, and had invested heavily in Oculus as well at the Series A and Series B. So, I was kind of joining this firm at this amazing time where the firm had done tremendously well. Had invested in lots of amazing companies. I think one of the defining characteristics of the firm, at least when I was there, and it feels like today too, is a really strong focus on entrepreneurs building unique and interesting products. Mm-hmm. It's a very product-focused firm. We used to try lots of products. We used to debate and discuss different products, kind of constantly looking over each other's shoulders, trying products out with each other. And it was interesting because I think in some of those early years, it led to us investing in a lot of amazing internet businesses. Other examples would be like Postmates, and there's a whole series of great investments. And then over time, as B2B software companies started feeling more and more consumer-like and accessible, we started to invest into companies like Slack, for example, which technically a B2B software company, but very much felt like a consumer product. It was one that we could actually use ourselves too. Yeah. Anyway, that was a big theme. And I remember talking with friends at other firms about their experience and what they were looking for. And one thing that stood out to me is that we spent way more time talking about and thinking about products than other firms, which is sort of an interesting feature.
So what was the transition into venture like? I mean, you'd had some early exposure through StartX and getting to know firms, but what was that transition into venture like? What was the on-ramp for the first 12 to 24 months post-joining?
It was exciting. It was very exciting. I think being at a firm like Spark, in many ways, you feel like you have this amazing window into what's going on in the world before other people. And I think that there were just unbelievable people walking in every day. I remember when, it's like Max Levchin came in to pitch a firm, and we were an early growth investor there, and Bastian from Postmates, and Stuart from Slack. There's this kind of string of amazing entrepreneurs kind of walking in the door and sharing what they're working on, and hundreds or probably thousands of entrepreneurs that we didn't invest in who are still like pushing the world forward in really interesting ways. So I remember just being floored by how many cool things were going on. Also, as a technical person, it was really fun because that was an area where I had a little bit of an edge, where I could, have a conversation with the technical founder in certain areas and be able to dive a layer or two or three deeper than others. It was also, though, like my first real job, right? I mean, StartX was an amazing experience, and being a PhD student was an incredible experience too, but it was less of working in a company. So I was learning a lot around, it's hard managing, a calendar. I think I met 300 to 500 companies a year while I was at Spark, figuring out how to do that well. Starting to attend initially as an observer, some of my first board meetings. Some of my partners were kind enough to let me tag along to some of their board meetings to learn, how does a board meeting run and what kind of questions are getting asked. And then, over time, then taking on some of my own boards as a director and kind of like learning that a few years in. So a lot of professional development, a lot of learning, and just a very exciting time.
You were there 6 years?
Almost,
was it,
yeah.
At Spark?
Yeah, I ended up leaving kind of right at the end of 2019, and then stayed on a little bit for approximately another year in kind of a part-time capacity, and continuing to serve on some boards.
In reflection, what did you enjoy about your time in venture capital? Like, what were the things that you loved, things that you kind of found a bit more challenging or disliked a bit?
Yeah. I think my favorite part of the job probably ties in with some of the things that we were discussing before around this, just having the ability to have this boundless kind of creativity and curiosity about the world. I mean, I remember at one point we'd met. Well, first of all, we had invested in Cruise. We led the Series A in Cruise. I had nothing to do with making the investment, but I was part of the firm at that time. And after we made the investment, the company very quickly was acquired by GM. And we had this moment where we all looked around at each other and said, wow, like AI is really exciting. This is I think 2016, right? 2016, 2017. And what are all of the different things that are happening in AI? And we looked at, there was software that we looked at. There's obviously way pre-LLMs. And we invested in there's some other software companies that we invested in. We looked at a lot on the hardware side. We looked at all the LiDAR companies, for example, that were supplying all of the hardware for, self-driving cars and other types of robots. And it was fun. We spent probably a couple of years really going down the rabbit hole there. Similarly with space technology. So we invested in a company called Capella Space. I believe it was in 2017. That is currently building these small satellites that unfurl these massive antennas in space to do radar imaging. It's called synthetic aperture radar. It's a really cool technology. And that was a result of a long series of research projects, which then extended, years afterward too, where we just went down the rabbit hole and just learned and learned and learned. So for me, that was incredibly fun. And it kind of tied back with some of the things I loved about academia, just getting to, sometimes people think about academia as there's a circle, and an academic's job is to kind of go to the edge of the circle and then poke a little additional edge to kind of extend humanity's knowledge a little bit more in that direction, and everyone's kind of just doing that constantly. It kind of felt a little bit like doing that as an investor. So I really enjoyed that. I also loved getting to work with entrepreneurs. I thought it was really fun. It was really inspiring. It was really interesting. There's one company in particular that we sort of incubated internally at Spark that I was involved with in the very early days, and getting to work side by side with this entrepreneur and talk with him and see what he was thinking about and have worked through problems with him. It was really exciting. So that was one of the things that I carried with me. And, back to the second part of your question, I think that a few years in, I started to feel this itch around building. And as time went on, the itch got stronger and stronger. And I think that over time, I realized that I really enjoy investing. I continue to, I angel invest now, and I really, kind of almost in many ways revere this sort of craft of early stage startup investing. I felt this desire to go and have more of a hand in seeing these companies through, and ultimately deciding that I wanted to try my hand at doing it myself, and building a company. So that was obviously a difficult decision to come to, but it felt right. Yeah, I'm definitely happy that I took the plunge.
You had an interesting exposure to VC in the sense that you did that first and then became a founder. Often it's the inverse, right?
Yes.
So, I guess you've got the benefit of kind of being in that industry now, being on the founder side. What do you think makes a great VC?
Oof. Well, it's funny because if you look at, the, I don't know, top 20 or 50 VCs of all time, just in terms of returns, and you look at their backgrounds and what they've done, there's actually pretty wide diversity of different backgrounds. Journalists, financial analysts, entrepreneurs, industry execs who became VCs later. Maybe there's a pattern there, but from the outside, it doesn't feel like there's a pattern. It feels like there's actually lots of different potential successful paths to being a VC. I don't know. As an entrepreneur, I think the thing that I tend to really value is investors that are willing to roll up their sleeves and work with me. But other founders feel differently. Other founders have more of a mentality of hey, I know what I'm doing. Give me some capital, don't bother me too much, and we're good. So I also think it's a deeply personal question in many ways, because a lot of it depends on how an entrepreneur wants to go about building, his or her business, what they value. And, someone who might be an amazing partner for one entrepreneur might be like a horrible partner for a different entrepreneur. So yeah, I guess it's kind of maybe it's a bad answer to your question, but I think that from a returns perspective, there's not an obvious pattern to me. And then from a personality and style perspective, I feel like it's deeply personal. So in many ways, it's kind of beauty's in the eye of the beholder.
True. And so did you discover the pain point for standard metrics whilst you're at Spark?
Yes. Yeah. That was something that I felt
like you still
was a big yes there.
Oh, big time. Yeah. Yeah. And look, I very quickly discovered that this is not an issue with the firm. This is just an industry issue. You had this, venture capital and private equity industry that had, really gone from a small cottage industry 30 years ago to a larger cottage industry 20 years ago to a growing industry 10 years ago to now a $7+ trillion global asset class. It's really grown a lot. And for that reason, and for other reasons that are maybe like a little bit more kind of product and technology oriented, nobody really figured out how to build great software for this industry for a long time. And it's really still in its infancy now. So, when I first got to the firm, I noticed that we were kind of running the firm mostly in Microsoft Office. This is back in 2014. And pretty quickly realized from talking with my friends that that's just kind of the way that things worked. And so, yeah, a lot of the things that we decided to focus on as standard metrics around automating reporting workflows, with portfolio companies, creating, reports that can be shared internally, discussed, collaborated on, thinking about LP reporting, trying to build automation to speed up the way that a firm operates and make better decisions. Those were challenges that I kind of personally experienced while I was at Spark. And then a lot that we've learned along the way from working with, incredible customers, and kind of learning through their eyes as well. Like you guys.
Indeed. Oh, we'll get to that. We what we've always found interesting, and it's true, that venture firms invest in technology, and technology companies. But when you look at how most of these firms historically have been run, it is the most non-technological way of doing things. Yeah. It's so basic still, right? And I mean, you would have a far better lens, but the feeling I still have is that if you went to 9 out of every 10 venture firms, maybe with the exception of people that are working with you, most would still say our baseline is that we still work on Microsoft Office.
For sure.
And that's so interesting that you are looking through the window of innovation. You have this sort of very privileged position, but the way you actually do things as a firm would be very much laggard, I guess, in approach. What's the reason for that, I guess? Like, why do you think that there's that disconnect? Yeah,
it's a great question. So my perspective on this, some of it has to do a little bit with the size of the industry, which I kind of alluded to before.
Yep.
So if there were amazing tools available 10 years ago for VCs to use, I think they would have adopted them, but the tools weren't there. There were some tools that had been built. They've been built kind of for different types of investors, not really with their needs in mind. And, there's sort of a legacy set of competitors that we kind of come across, especially with some like larger firms that maybe have a little bit more of a private equity bent.
Yep.
And, those tools never got significant penetration in venture. And it's not, I think the reason is because it didn't meet the firm's needs well. So I think that's part of it for sure. No one had really thoughtfully designed a system that would work well for VC. And I think the reason for that is that the market was frankly too small. Like one question that we get a lot is like, isn't VC like a niche market? How are you going to build a big software company selling to VCs? There's like 22,000 entities that have invested in startups over the last year. And of those, there's thousands and thousands and thousands and thousands that have raised over $100 million for their funds. So, we're living in a different world now than we were 20 years ago. I think rough numbers, I think this industry's expanded by roughly 3x over the last decade. Now, of course, you could say some of that has to do with like zero interest rates and, how much of that is sustainable. But then we also see some of these large firms getting larger and larger and larger and taking on new strategies. So I think you had a smaller market that was harder to attract really ambitious entrepreneurs to come and build for. And then you had tools that were built for different kind of adjacent asset classes that were they're kind of cross-marketed to venture, but never really fully clicked, and probably some, heartburn because of that. And then, we kind of arrived at the situation like the one that we found in 2020 when we started the company, where, as you said, the vast majority of firms were not using any software to kind of manage their internal data. Pretty much all of them knew that was a problem in one way or another, but they weren't really quite sure how to fix it and what the right steps were. And the strategy that we took, which I'm happy to go into more detail, obviously, and you guys know the product well, but the strategy we took of building a network was a pretty edgy and ambitious one at the time, because people thought like, okay, so we got to get the companies to use the product too, but then you have to get the investors to also use it. And it felt like this kind of chicken and egg problem. So there were a lot of skeptics early on. We actually, over the last, year, there's a lot of firms that we've signed that we talked to in 2020 for the first time.
Is that right?
And now are sort of seeing the network and saying, oh, okay, the chicken and egg problem kind of, it's no longer a chicken and egg problem.
Yeah, interesting.
It's just chickens or whatever.
We like to ask this question to all guests, but do you remember day one?
I do remember day one. So we had an interesting founding story, I think partly because of the way that the company got started and also the time that the company got started, which was right at the beginning of COVID. So when I first met my kind of co-founding team, who was a group of entrepreneurs out of 8VC, it was in January of 2020, so a couple of months before the madness kicked off, and I remember going into 8VC and meeting with a group of people who were all taking some of their time to kind of hack on this idea that they had, and it turns out that idea was this code named Quaster, which is the original name for our company, and I think you guys became customers while we were still called Quaster, if I recall correctly. So 8VC had a lot of the same problems that I had when I was at Spark, and they had tried one of the legacy tools in the space and it hadn't worked, and they decided we need to go back a company that's going to build modern digital financial infrastructure for the space. And they actually had a couple of engineers and a designer and a PM and a few other people who were starting to spend some time working on this and building a prototype and testing it out a little bit. So that's when I met them. And I remember walking into their office for the first time, because I think I'd been to 8VC's old office, but this was the first time in the beautiful new office on the Embarcadero, and meeting with the team and immediately having this mind meld and being like, yes, this problem is a problem that I deeply, deeply care about, and getting really excited about it. So I remember that I wasn't technically part of the team at that point. I think I became part of the team about 2 months later officially, but spent a couple of months really getting to know folks and aligning around the problem and what we wanted to do. And it was a really, really exciting time. And then, of course, right after we had basically signed a term sheet to raise our seed round, the entire world shut down. And, my wife was five months pregnant, I think, with our first kid at the time, and just started a company. And, so the first 6 months or so was exciting, but very odd as well, kind of being marooned at home and being thrust into a different world.
Had you made the decision to leave Spark at that time?
Yes.
Yep. So you were starting to think about idea generation when you sort of came across this.
Yeah, it was about a month after I had sort of left the firm, although I was still kind of working with some of the portfolio companies during that time. So it was sort of a free agent-ish already.
Yeah, interesting.
And what about early decision making? So you've obviously raised a seed round, and if you think about productizing for private markets, it's such a bold vision, right? And there's so much to build for. There's so many pain points. Like, post that round, like what were you guys focused on? It's like, okay, key hires, validating more, building an MVP. If so, what did the MVP have to look like?
Yeah. Well, I think in the early days, one thing that I'm really grateful for is that there was a really strong sense of alignment on the team that the only thing that mattered was finding product market fit. Everything else was, everything we were working on needed to be in service of finding product market fit. And there's actually certain decisions that we made that, later on, years later, I thought, oh man, that was definitely the right decision at the time. But I kind of wish that I had post-product market fit, spent more time focusing on that problem or that problem.
Right.
But in the early days, we were entirely focused on that. So we spent, effectively all of our time either hiring people that we needed to hire to build a great product, or spending time with customers and listening to them and learning about their needs, and then trying to build something that was disruptive and interesting and solve their problems that they wanted to buy. So that first, I'd say that first year and a half, like, I think I'm trying to remember what month we brought on you guys, but it's like probably April of 2021 as a customer or
That's
something
right.
along those lines. That was like right at the, like, we kind of have product market fit. It's definitely sort of working, but we're still, there's still a lot that we're figuring out. So that period of, let's call it March of 2020 through maybe mid to late 2021, we were laser focused on that. Lots of communication. Every call we had with customers, we were just posting notes and discussing and debating, and it was this kind of whole company focus on that. And it was really exciting. I'm really, really happy that we operated the business in that way in the early days, because it allowed us to really triangulate quickly and identify this problem that folks were facing. And in that primary use case that we, honed in on, and is still really the core of our product today in many ways, around reporting and data collection and making that fast and easy and useful for both sides. And that was something that we discovered and learned how to solve through, hundreds of customer conversations, including some people who bought our product and then many who didn't, but we learned a lot from the process.
I remember, I think I put the initial request in to chat to you guys.
I forgot about that.
Yeah, because it's like, I think when you grow up in venture through your associate years and then onwards, you inevitably get tasked with the portfolio data collection and monitoring, right?
Yeah.
And so it's like the thing you have to do. And so when we started January, I was like, I want to break the mold finally. I'm not going to make our associates do this to the same degree that all of us otherwise had to. And, it was a fairly obsessive journey that I went on. Like, I think I spoke to 15, 20 people that were probably in that first wave of when you guys were sort of looking to break out of trying to solve this. And I think, candidly, maybe a lot of them still exist, but I don't think have probably got to that early category leadership. And I remember in that first call, it was like, this is it. Like, this is the one. I've found it. And I think we've probably one of the more prolific users of the platform for our relative scale. I think Paul from our team is one of the most active users on the whole Metrics platform. But, talk to us about the decisions and the features that you decided to build early on. Because as Alex alluded to, it's such a broad ambition that you held. And what were those early features that you found were just delighting people? Like, what was it that really got the accelerant for you guys early on in terms of adoption?
Yeah, for sure. So I think that there's a couple of key things that we decided to build that were really impactful in driving value for our customers. And many of those things were some of the most, I'd say, like, opinionated or edgy things that we decided to build. So, for example, from day one, we decided we need to have a company side product. We can't just be a single player tool for investors. And there's a bunch of reasons for that. I think one of the key reasons is, in the venture space, at least, and in the private equity space too, but certainly in the venture space, companies have many, many investors, many shareholders. As companies, mature and bring on additional capital, it's not like you have one major shareholder, right? You might have 3, 5, 7, 10 folks that are, own a significant portion of your company. They probably have information rights. Some of them might serve on your board, and you have an obligation and in sort of a benefit in many ways, we think, to equipping them with the latest information about how your company's doing and what you need help with. So if in that world, why would it make sense for companies to work on like 10 different systems? It would make sense for them to work on one system. Now, getting to that one system, again, we get back into this chicken and egg problem, but building a product for companies was a tough decision. And there's so many opportunities to get off that, that ride over the years, because, investors have lots of feature requests and they're interested in this kind of analytics and this kind of thing. And, by having two sides to the product, you're always diverting a significant portion of your engineering and product resources toward building a great experience for companies, not just a great experience for investors. However, because we focused on doing that, it allowed us to do things that not only made the experience better for companies and faster, for example, building accounting integrations, which it turns out is sort of like one of our most successful things that we've built to date. Is companies, when they sign up for Standard Metrics, they can integrate their accounting system, and then it automatically pulls data into Standard Metrics on their behalf, and it always updates it. And then when investors ask you for data, you can either set it to autofill and send data right back, or it'll fill in a report for you and you can review it and then, send it off to the investor. That saves our portfolio companies tons of time, and it gives investors generally a much greater depth of data than they used to have. So it's just kind of wonderful thing where it provides more valuable sides. So that was opinionated at the time, very edgy, like, oh my gosh, like, companies would do, no company would ever do that. But it turns out that a lot of companies want to speed up their reporting and have a good relationship with their investors and trust them and want to be able to provide that kind of information to them, especially if they're able to, review it first. So that was one of the things that we really doubled and tripled and quadrupled down on over the years, that now at our scale, where we have, approximately 8,000 companies in our network, is a huge benefit that we have. When we go talk to a net new investor, the probability that they have a significant percentage of their companies on standard metrics, even if they're not based in the US where we started, is high. Our concentration here is higher, but because of, folks like you, in Singapore and Australia and other areas, we have, companies all over the world using our product now. So there's more and more overlap, and it makes it easier for us to onboard new investors. And then as the experience gets better and better for companies, they start to refer their other investors to come buy our product. Like, we just, over the summer, brought on a customer like that. We have another customer that we're hoping to bring on very soon that was just referred by a portfolio company. So this kind of beautiful bottoms-up thing that's happened. But it's taken 4.5 years of, sustained investment to really feel the impact of that. So I think it was like a tough and opinionated early product decision that we felt like was strategically the right thing to do, and we're now very grateful that we invested in. And then there's other aspects of the platform I could talk about too. For example, we built a tool that links financial reporting data requests with producing reports we call tear sheets that can be sent to LPs or used internally. And the kind of automation that we built around that has definitely been a really useful tool, and something that I personally did by hand in Word docs when I was an investor. And then another thing that I maybe mentioned to wrap up is our API, kind of investing in having a robust API. We're really grateful that we made that investment and are continuing to invest more, because an increasingly large percentage of our customers are going and doing creative things. They're building their own applications on top of our data. They're building their own data warehouses, and we think that investors will become increasingly sophisticated with how they use data, and being able to be a good technical partner to them is a really important aspect of what we do.
Yeah, I was going to say, AI obviously unlocks a bunch of use cases, right, for a platform like Standard Metrics. How do you think through? Obviously, a lot of things have changed in the last couple of years. How do you think that complements or challenges Standard Metrics?
Well, it's a great question, and it's definitely one that we get a lot. I think everyone in the industry is really excited about it, and I probably struggle to think of a single investor that hasn't tried to start kind of hacking some of their own. Like, oh, well, what if we use ChatGPT and kind of feed in these types of things and kind of see what comes out. And there's a lot that you can do with that already. It's really impressive. On the other side, everyone's asking, okay, great. Well, I have all this data organized. How do I get insights from that data? How do I customize reporting? How do I, one of the interfaces that we're really inspired by is Perplexity. Like, how do I ask questions and get answers? So, when we think about the future of our industry, and there are some other competitors that we sort of see in the industry, there's a couple of different approaches that people are taking around this. I think one approach that's been used for the last, let's call it like 4 or 5 years, kind of predating LLMs, is let's make it really easy for people to parse data out of documents by building effectively like templates. So you kind of know how a portfolio company reports their data. And next quarter, when they report their data, we've built some technology that's going to speed up data extraction out of that document. That's actually like a common theme that we've seen a bunch of different companies take. Our point of view on this when we started was, hey, let's focus on building an amazing system of record and a really great reporting network. And then as some of these new advancements in AI have come out, our focus is shifting to how can we leverage that to kind of like deepen this moat that we've built. So on the way in, how do we ingest data faster? And on the way out, how do we provide insights faster to people? And our focus is very much right now on the former. So So what we've built and we're in the process of continuing to develop now is technology that allows us to much more rapidly ingest data from thousands and thousands and thousands of documents, with the caveat that we need to provide extraordinarily high fidelity of data to our customers. For example, if you are trying to extract data out of a document for the purposes of planning a vacation, if there's a mistake here and there, it is what it is. If you are, a publicly traded company that has a corporate venture fund and the, results of your venture fund are being reported to Wall Street, you got to make sure that the data is accurate. So the way we think about that is data accuracy is more important than speed, but both matter. So finding the right trade-offs between the two. So we look at these advances as being extraordinarily helpful on the way in for data ingestion, and we actually think will be, in the not super distant future, completely a commodity. Like being able to extract data out of documents will be a commoditized process. But of course we want to do it really well. And then on the way out, that's where I think things get even more interesting, which is like, can you start to build persona specific applications that help people to get the knowledge that they need from their data as quickly as possible. And ideally not just the knowledge from their data, but the knowledge from what's going on, broadly speaking, in the market. And that's where we start getting into some of the things that we've built around benchmarking, which I'm happy to talk through. A question like, which of my portfolio companies are growing in the 75th percentile or higher in terms of revenue right now? That's a really interesting question that pre-standard metrics, you could kind of intuit perhaps or guess, and now we actually have like the data to back that up. And we want to make the process of getting answers like that lightning fast.
Let's shift to people. In the early days of standard metrics, were there certain traits or qualities of people, or even, in your experience with StartX, right? Like, do you think there's specific traits for early stage employees that stand out amongst others?
For sure. I mean, I think that, it goes without saying that intensity is a really important one. I think that there's different sides to it. I think certainly intensity in terms of work ethic matters a lot. You need people who are really in it because the odds are so stacked against you as a startup. You're battling so many different things. You're battling inertia, you're battling maybe competition, you're battling general kind of chaos of trying to, organize a business. But the one way you can really win is by tapping into like a deep, deep, deep need that a customer has. And the way that you do that is through just like kind of unmitigated intensity and focus. So I think people who are very intense is really important. And then I think that as time goes on, intensity continues to matter a lot. But then also being able to really effectively collaborate well between different groups matters a lot too. So when it's, just engineers and product people, for example, you don't have to deal with some of the challenges that exist when you have, someone in sales or someone in customer success that are kind of also advocating, ideally all with the same end goal, but with different perspectives. So, super early on, I'd say, intensity and customer focus for me is probably like the biggest thing. And then as time goes on, hopefully not losing that, but then also bringing in the ability to kind of see the bigger picture and think in a business-minded manner. So one of the things we focused on, for example, with hiring early engineers was engineers that understood the business problem really well. And I think that really, in many ways, really paid off because we had engineers that could start thinking carefully about some of the trade-offs that might exist around like solving a customer's problems versus taking a really elegant solution. And sometimes those line up and sometimes they don't. And so those are some of the things that we thought about, really early. And but the intensity one is definitely one that I like keep coming back to and thinking about. And it was really those early days of kind of like looking around, at that time mostly on Zoom, and seeing a group of people that cared, as much as I did about the problem we were solving was really, it built a great kind of intense early culture.
Talk to us about culture, and I guess the approach you guys have taken as you've scaled the team. Was it, day one we're going to sit down and write down the mission, the vision, and indoctrinate, or was it that we're going to let that form over time, and we're going to work really hard, and that'll sort of figure out, and then we'll formalize it? How have you approached culture building and kind of formalizing the framework and processes around that?
Yeah, so I'd say a little bit of a combination between the two. Definitely an iterative process. When we first started the company, we sat down and kind of had this open conversation of, what do we believe in? How do we want to run our company? Which is really a reflection on the founding team in many ways. And then as time went on, that was kind of a nice scaffolding from which to build.
Yep.
And we've kind of done multiple iterations. The vision for our business, for what we want to build long time, sometimes we refer to it as this kind of like lingua franca, this common language for the private markets, building this network, this tooling that allows people to make better data-driven decisions and ultimately allow the industry to innovate faster. That's always been like a North Star for us. But some of the specifics around, how our team operates day to day, we've definitely kind of evolved and tweaked over time as we've learned about ourselves and as we've grown and the needs of our business have changed. So it's been a little bit of a combination of like top down and bottoms up and iterative. I think for me, one of the things I've always been proudest of is when individuals on the team like hold me accountable to our values. Like that's something that's always like kind of a proud, CEO moment. Like I've had that happen before where someone says, hey, like, well, one of our values is working in the open. So we like try to really work in the open as a company. It means that we're, working ideally as much in the open as possible, and platforms like Notion and Slack, people can follow along. We are remote first. And always have been, although we do have an office in San Francisco too. So the idea that anyone anywhere in the world can, open up Slack or Notion and kind of see what's going on and understand, like that's really core and important to us. And it also ties in with this theme around feedback, which is a big deal for us. It's like, how do we have a culture where people are really receptive and open to feedback? And I always really encourage the team to give me constructive feedback. So sometimes people on the team come to me and say, hey, John, like we made X, Y, and Z decision, and I really think it doesn't like align perfectly with this value. Can we talk about it? That's always that makes me the proudest. Like I feel like I'm being held accountable by our team around our values. And I really enjoy that aspect of working with our team.
How have you evolved in the period since you started? I mean, and what's interesting is you sort of, I imagine, had perceptions of what made a great CEO when you'd been on that journey, investor lens in. What's been that journey? What are the reflections thus far? And how did it differ from what you perceived, coming from an investor world?
Yeah. Well, I think I've evolved a lot, and I think I'm going to continue to need to evolve a lot to build a successful business ultimately, because, I've learned that running a business, we're approximately 50 people now. A 50-person company is totally different from a 20-person company. It's totally different from a 5 or 10-person company, and I imagine that running a 100 or 150-person business is also going to be very different. I think a lot of the ways that I've evolved have been honestly by making mistakes, and like, realizing that I made a mistake and trying to learn from making that mistake and having conversations about that mistake with other people. Some of those people are people at our company, and some of those are people that are oftentimes like other entrepreneurs that I'm friends with or trust, and I can go to them and say, hey, did you make this mistake too? And usually the answer is yes. And so for me, I think there's definitely and it kind of comes back to my comment before around finding product market fit, where building a business is so messy and so difficult, especially when you're trying to build a really fast growing technology business, that ultimately you can afford to make a significant number of mistakes if you are building a product that people really care about. So that's been sort of a lot of my growth loop. There's also been a lot of great learning that I've had from bringing awesome, smart people, onto our team to help us to grow and to build and see around corners. And we try to think from first principles as much as we can at our company, where we know that there are useful learnings from other companies, but we always try to be a little bit cautious about like applying those learnings indiscriminately, because it might not apply to our business the same way or differently. But there are definitely a lot of really useful kind of learnings that folks have brought in and helped me to grow, as a CEO. I think one example of that might be around, thinking about, for example, the customer success. You start a business as a CEO, a founder CEO, first-time founder CEO who's never worked in customer success. That's not necessarily like an intuitive. You want to make sure customers are happy, but there's a whole set of like best practices that really help to strengthen that sometimes bringing folks in can help to just like understand and accelerate. And I think the other thing that I've really tried to kind of grow around is learning to do a good job running a leadership team, which is also something that I had never done previously. Working in a venture firm, very different kind of structure, right? And kind of a partnership structure versus a company. And then leadership teams really evolve over time. Like our leadership team now, even though it's actually kind of roughly the same size as it was a couple of years ago, it's a very different challenges that we're facing, some different people, different scale. So yeah, tons of learnings, and also just a expectation that those learnings are going to increase, if not accelerate, moving forward. And if I want to continue to be a good steward of this business, I need to grow at least as fast as the company is.
Yeah. I want to shift to fundraising advice.
Sure.
So, I mean, through the lens of standard metrics, or even through the lens of your experience as an investor, right? For early stage founders listening, what would be your advice for running a good process?
Well, I would definitely say first off that finding investors that really care about what you're doing is really helpful. I mean, I can give you guys a specific example that's probably pretty like close to home, but working with you guys, you approached me before we were raising our Series A and said, "Hey, we love your product. If you guys are raising at some point, let us know because we really like what you're doing." Looking for those kinds of signals and valuing those kinds of signals, I think, is really important. Now, that's a fortunate place to be, right? We also sell software to venture capital firms. So there's this sort of built-in audience of people who are like excited and interested in what we're doing. But I think the enthusiasm goes a really long way. It also goes a really long way in hiring, by the way. Like somebody who's really genuinely excited about working at your company, that's cool. Doesn't necessarily mean that they're going to be a great hire, but it's certainly a good starting point. Same thing on the investor side. I think the other thing is trying to make sure that you're telling a story that is a match to what that investor is looking for. And if what that investor is looking for is something that your story isn't really a match for, kind of trying to recognize that as early as possible is another thing. It's kind of like in sales, right? Like, ideally you're spending as high a percentage of your time as possible talking with customers that are really genuinely interested in solving a problem that you can help with. If they really need help solving a problem, but it's not one that you can really help with, you spend a bunch of time with them is probably not really going to lead to a great result. Or if they really have a problem, but they actually can't solve it right now because they don't have budget or whatever, maybe spending some time with them is a good idea, but evangelizing for the future versus accomplishing something now. I think it's the same thing with investors. Like if you talk to an investor and you're fundraising and then an investor says, "Oh, this looks pretty cool. Like, let me talk about it with my team and get back to you." And then they never follow up with you. That doesn't mean you shouldn't, maybe send them a friendly reminder, but it might mean that they're not interested in investing in your company. Whereas if somebody is kind of persistent and excited and leaning forward and trying to help you with things, like those are people to really prioritize. Similarly, one thing that trips up founders a lot, and I've fallen into this camp too, is understanding like whether or not the profile of your business fits an investor's kind of strike zone at that time. A lot of investors love to get to know people early, but maybe you're a company that they'd be interested in investing in 2, 3, 4, 5 years from now. Once you've gotten a little bit bigger, a little bit later stage, something about unit economics or revenue scale or profitability in certain cases, and learning how to identify those people early and ask the right questions to understand what their profile is. And it turns out like it can feel a little awkward sometimes, but it's pretty easy to say, hey, like what kind of revenue do you look for when you invest in companies? Do you have like a revenue scale that you're typically targeting?
Yep.
And so I think some founders feel embarrassed to ask that, but then they get to the end of the process and it turns out that investor is looking for, 10 million in ARR and they're at, 500K, and it's just like a complete, but they wanted to dig in and learn, maybe even if they're genuinely interested, but 3 to 5 years in the future, whenever that is. So I think having that transparency and being able to ask these almost like discovery-esque questions of investors, it's not all about the investor asking you questions about your business, also about you assessing a fit and figuring out if they're the right type of person for you to be spending time with during the process.
As we start to wrap up, let's talk future state. What does Standard Metrics look like in 5 years?
Yeah. So I think right now, Standard Metrics is probably best known for providing financial reporting software for venture capital firms and for startups. And I think if you fast forward, 5 years that is very much still the core of our business. I think that there's a couple of things that will continue to grow, and a few new things that we'll be building as well that'll have a really big impact. I think for starters, we are going to be known not just for our delightful, fast, easy workflow software that we've built, but also the insights that folks are deriving from our data. And that ties in with this product that we've built and launched recently called Global Benchmarking, which you guys are familiar with. But effectively what we've done is we've built this tool that aggregates, anonymized data from the 8,000-ish companies on our platform and delivers insights back to portfolio companies and lets them know how they're performing against other companies at their stage in their sector across a variety of kind of key growth and efficiency metrics. Similarly, investors can access a similar tool and are able to look at their own portfolio companies and understand how those companies are performing as well in the context of the broader market. And we've seen a bunch of super creative applications of this already, from assessing strategies within a fund's performance, to companies using this during fundraising processes, to investors looking at prospective investments through the lens of benchmarking and using it to guide, new investment decisions. And we think that part of our job over the coming years is not just to grow this data set and build more, useful ways of kind of slicing and dicing this data set, but also productizing some of these specific applications that folks are kind of going and almost like developing on top of what we're doing. So I think that's going to be a big deal for us, and will be a more and more kind of core part of our business in the future. The other part of the story that I think is exciting is, we see venture capital and startups really as the starting point for what we're doing. And there are lots of other types of investors that are very similar and have very similar needs, and in certain cases have overlapping investments. Take like the growth equity world, for example, where it's like, it looks like private equity in some ways, it looks like venture capital in some ways, it's a little bit of a hybrid of the two. These adjacent segments to what we're doing are kind of chronically underserved by software as well. So we see a lot of opportunity to continue expanding our business, but obviously kind of keeping this core focus on the customer base we've built. I think we announced recently that we just crossed 100 VC customers, which is awesome. As I mentioned before, there's like 22,000 firms we could go and sell to. So we've really scratched the surface, but are excited to continue kind of expanding and serving other types of customers that have very similar needs, and we think we can really, really help out.
How do you think the venture growth equity ecosystem is going to change in the next decade? And how will that affect Standard Metrics positively? What challenges will that create as well?
I mean, I guess one observation that I have looking through the lens of our customers and what our customers are doing is, it feels like the lines are increasingly blurred between different parts of the asset class. Broadly speaking, the kind of venture capital and private equity asset class, where, you have firms that are doing classic venture investments. Then you had the rise of these kind of like multi-stage firms. Now we're increasingly seeing, firms doing like PE style roll-ups. There have been these kind of like crossover funds for a long time, of course, that own like, public and private, and there's, VC and PE firms that are involved in like, taking companies private that you wouldn't have necessarily expected. So there's kind of like a little bit more blurred lines between these different parts of the asset class. I also think that the operation of these firms is going to change significantly, due in many ways to software and new technologies. For example, like if you have a firm and you take like 90% of the time that people were spending on various tasks to kind of just like keep the machine running, and you're able to automate that and give that time back to them, what are they going to use that time on? There's lots of different things they could use that time on, right? I think it's going to, first of all, it could definitely help firms to lean deeper into providing services for their portfolio companies. You've seen firms, spin up like GPU clusters for their companies. Obviously, firms that have spun up significant recruiting efforts for their companies, which is really interesting. And then the other question is, well, if you start equipping firms with like amazing data, does the nature of making investment decisions start to evolve and change over time? What about risk management? That's another thing where, like, if you look at how firms make decisions, even something as simple as how much money should I invest in this company? How much money should I put into this follow-on? How much money should I reserve for this portfolio company? A lot of it is very finger in the wind. But you start to think over time about, like, you've got all of your data that's extraordinarily well organized. You have access to all of these unbelievable kind of anonymized benchmarks. You can start to model these things out and start to get a sense for what optimal might look like, which might not be exactly what a firm does, but it might be this kind of almost default state of starting to use data to make decisions.
It almost brings the public equity element into
Yeah.
private market.
That's the trend that we're seeing. And of course, you see crossover between the two. Like, you see, public investors spin up these private arms. And then I think you just see in general firms kind of desire to make more data-driven decisions around investing. So we're talking our own book here a little bit, but I do see data-driven investing as being an increasingly important theme. And then I think that the increasing level of automation that we're going to see is going to help firms to, I think, really provide deeper services and work more closely with their portfolio companies than they have in the past, if that's what they desire and that's what their entrepreneurs desire as well.
Do you think you'll see the same 3xing of, I think you'll see a 3xing at a minimum of the AUM base, but will you see a 3xing of the number of firms, or do you think that consolidation and concentration will?
That's a good question. It's a hot topic because I mean, I think if you look at the numbers, there is certainly a trend of some of the largest firms really over the last few years, during some shakier times in the venture market, raising massive amounts of money to take on some of these different strategies. I don't know, honestly. I think it's inevitable that some of the firms that got started over the last 5 years are not going to be able to go and raise, fund 2 or fund 3 or whatever it is. That's always been the case, that there's this sort of natural, some firms are able to make it and kind of continue going, and some aren't. On the flip side, again, potentially because of technology, the barriers from like a personnel perspective to starting firms is also going to get lower and lower.
Yeah.
And so I don't know what the consolidation is going to look like. Part of the reason why we're excited to support both many of the largest firms in the world on our product and also a significant number of much smaller firms is that we do want to support the industry in whatever way it ends up kind of growing.
Yeah.
And I think you could make a pretty thoughtful case for, the biggest firms continuing to get bigger, which I'm sure will happen. But the question is, does that happen in comparison to this long tail of smaller firms or not? And I think time will tell, but I do not know yet.
Final question. If there are any kind of final words of advice or learnings or war stories that you could share with founders that are listening, what would they be?
Well, I'd say, first of all, I feel really, really fortunate to have chosen to work on a startup that I really care about. Like, just genuinely care about. I think it's like, there's lots of different ways of doing this, and there's probably lots of successful examples that one can point to for, a founder who kind of discovered a problem and decided to go after it because they thought it was a good business idea and built, a multi-billion-dollar business, and everyone was super happy. For me, though, I really have benefited from working on a problem that just like has kept me up at night for so long, that I care about deeply. And, when you have a bad day or a bad week or a bad month or a bad quarter, which inevitably happens in startup life, that you can kind of turn back and say, I really care about this. I really, really care about that. I'm going to keep going. I'm going to keep going. Having the grit and the desire to keep going is I think, critical. And that's been a useful tool for me. So that's definitely one. And then I think the other one is this theme that we brought up before around like spending time with customers and kind of relentless search for product market fit. One of the things that I've learned is that this partner at First Round Capital named Todd Jackson, who was a really great kind of content around this, and I think they created like a program at First Round now about this too. It talks about like product market fit's not binary. It's not like a 0 or a 1, right? Yeah. There's like levels to product market fit. There's sort of like nascent and kind of emerging product market fit, strong product market fit, and like extreme product market fit. And there's actually ways that you can quantify some of those things with data, looking at things like, revenue retention and, kind of customer behavior. I think that's one of the things that I've realized is that, first off, relentlessly focusing on getting to at least some form of product market fit in the early days is the most important thing. I think it's really easy to get distracted by all sorts of other things that founders are kind of, get invited to a million dinners and, let's go to this conference and that conference. And it's not bad to do those things sometimes, but if it's not in service of the most important priorities of your company, it's probably like not a good thing to be spending time on. And then I think the other side of it is, that's not static. That's not like, I found it and now I have it forever. Like the market evolves, the competitive landscape evolves, things change, buyer preferences change, technology changes. So being as focused on sustaining and improving product market fit throughout the course of building the business as possible, I think is really critical. And I think it's really important for the CEO of the company to be really deeply focused on that.
John, thanks for joining us on the first podcast.
Thank you.
Thank you.